Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at Lithium Americas.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. We are talking about a company that has really positioned itself right at the epicenter of North America's EV supply chain.
That's Lithium Americas.
Exactly. Their whole mission, the entire focus of their valuation right now is the development of the Thacker Pass project in Nevada.
And for anyone watching this space, Thacker Pass it's a huge deal. It's considered one of the most important projects on the continent.
It is. And what's so compelling isn't just the size, it's the speed, the pace at which they're turning plans into dirt-moving reality.
Okay, so what have they been doing lately?
If you just look at the last 3 months, say August to October 2025, the capital deployment has been breathtaking. This isn't just on paper anymore.
They're building.
They are building. Construction in progress has rocketed past the $1 billion mark. It's at $1.02 billion.
Wow.
And to give you some perspective on that, they capitalized nearly $146 million just in the third quarter of 2025 alone. They are executing, and they're doing it fast.
That kind of pace, it's necessary for a project this big, a generational asset build. It just drinks capital.
It does. And on the compliance side, they're ticking the right boxes, too. They filed a specialized disclosure report back in August, which detailed the project economics and confirmed their permitting status.
So they're signaling to the market that the timeline is firm.
That's right. But deploying capital that fast, it brings up the big question.
Funding. How are they paying for all this?
That's where things get really smart. We saw 2 major moves that really solidified their financial runway.
Okay.
First, they completed a $250 million at-the-market program, an ATM.
And that brought in how much?
It netted them about $246.4 million. An ATM is a great way to do it. You're selling stock directly into the market over time, so you get a much better price.
Right, not like a big secondary offering that can tank the price. But that is still dilution.
It is. But the bigger story, the real story, is the government involvement.
The DOE loan.
The DOE loan. They recently drew $435 million on it. And what's really crucial here isn't just the money they drew, it's that the loan itself was just expanded.
To what?
To a whopping $2.23 billion.
That's not just money, that's validation, right?
It's massive validation. When the Department of Energy commits that kind of capital, it significantly de-risks the entire project. It tells you Washington has skin in the game.
And that kind of conviction, it's contagious. We saw Van Eck Associates report a big stake, too.
We did. Beneficial ownership of nearly 6% of the common shares as of September. The smart money is definitely moving in on this.
Okay, but we have to talk about the Q3 results, because on the surface, that headline number could look pretty scary.
Yes, absolutely. We have to address it. The headline was a net loss of $199.2 million.
Which sounds awful.
It does. And if you don't dig deeper, you'd run. But when you unpack it, you see this was almost entirely non-cash. A huge chunk, $190.4 million, was a loss tied to an accounting rule.
Specifically, the fair value of an embedded conversion feature. Let's break that down.
Let's simplify it. It's a paper loss, not cash going out the door. They have these special notes debt that can be converted into company stock later.
Okay.
When the stock price goes up, the value of that option to convert also goes up. Accounting rules say the company has to record that increased value as a liability.
So a rising stock price actually creates a bigger loss on paper. It's counterintuitive.
It's completely counterintuitive. A huge loss here can actually be a signal of market optimism about the future. It reflects their financing structure, not a hole in their budget.
Okay, that makes sense. But it does bring us to the fundamentals. And the big one is they're not selling anything yet.
Precisely. They are pre-commercialization. No real operating revenue. That's why analysts project a negative EPS for 2025, sitting around minus 29 cents.
But that's expected. You have to spend money to build the mine before you can make money.
Exactly. It's a trade-off. You endure these losses while you build the foundation. The consensus view is that these losses will narrow significantly starting in 2026 as Thacker Pass ramps up.
And the reason investors are willing to stomach that is because of the asset itself, the competitive moat.
It's all about the asset. They own 100% of Thacker Pass. And it's not just a big lithium deposit. It is the single largest known lithium reserve in the entire United States.
A truly foundational strategic asset.
And its location is just perfect. Proximity to all the new U.S. auto supply chains. That gives them a huge head start. They're perfectly positioned for onshoring incentives.
Like the Inflation Reduction Act, the IRA.
Especially the IRA. It's not just a general incentive, you know? There are very specific rules.
For the EV tax credits.
Right. The batteries need a certain amount of domestically sourced minerals. If automakers can't get that domestic lithium, their cars don't qualify for the full credit.
So Lithium Americas isn't just a mining company. They're basically a key that unlocks those tax credits for the entire U.S. auto industry.
That's a great way to put it. They solve a massive strategic headache for automakers and the government. That scarcity value plus the policy tailwinds, it's a powerful combination.
But let's balance the view. No project this big comes without risks. The biggest one has to be execution.
It's always execution risk. They're moving fast, and speed can introduce mistakes. And there's another layer here.
Technology.
Yes, the processing technique. Thacker passes lithium from clay, not the more common hard rock or brine operations.
So it's a newer process, at least at this scale.
Exactly. The tech is proven, but scaling it up to handle these huge volumes of clay, purifying it, that brings in a specific, heightened execution risk. Any hiccup could mean costly delays.
And it's in Nevada. Water is always a sensitive issue there.
Always. Managing local environmental concerns, especially water usage, is a constant part of the risk profile for a project like this.
And that's tied to financing risk, right?
Yeah.
Delays cost money.
They do. Even with that huge DOE loan, they might need more capital to get all the way to positive free cash flow. If that comes from selling more stock,
Means shareholder dilution.
which is always a concern. And finally, you just have the commodity price itself. Lithium has been a roller coaster.
Up and down and down and up again.
A deep dip in prices before they're fully operational could really squeeze their project economics. The risks are clear.
And those risks are why the stock is so focused on catalysts. So let's pivot. What should we be watching over the next 3, maybe 6 months?
Okay, so you've got your scheduled catalysts, the ones you can put on your calendar. Most important is the Q3 earnings release, which is expected around November 13th.
And we're not just looking at the bottom line number there.
No, we know that will be messy because of the accounting. We need the operational updates. Construction timeline, project costs, their cash runway. That's the real story.
And then Q4 earnings will follow that in February. What about market-wide events?
Well, there's potential for inclusion in the S&P 500 ETFs when they rebalance. That's usually around December 15th.
And that's a big deal. The passive funds have to buy, which can create a lot of upward pressure.
A powerful driver. And then you have the usual year-end institutional buying, which often peaks in mid-January.
Okay, so that's the scheduled stuff. Now for the interesting part, the speculation, the rumors.
This is where it gets fun.
Yeah.
We have to stress these are unconfirmed, but they're out there. First one is about General Motors.
GM already has a big stake, right? A 38% JV.
They do. And the chatter is that they may significantly increase that investment, maybe even move towards a majority stake or full ownership.
For GM, that would be a game changer, securing 100% of the output that locks in their supply chain for the IRA credits.
It would be a huge strategic move. Then there are whispers of new interest.
From who?
The talk is about a major Asian battery maker or maybe a big international mining firm taking a large strategic position. Again, that would validate the project and inject a lot of capital.
And what about more government money?
There's industry chatter about possible new federal or state grants for critical minerals, something on top of the DOE loan that would de-risk the remaining spending even more.
And the final rumor, the one everyone loves to hear.
An accelerated timeline. Whispers that permitting and construction might be moving faster than projected.
If they could pull first production forward by even 1 quarter.
The stock would re-rate immediately.
Okay, let's look at the chart, the technicals. It's sitting around, what, $4.46?
About that, yeah, as of mid-November. But look at the range this year. It's been from a low of $2.31 all the way up to $10.52.
A true roller coaster. Why so volatile?
It's the nature of these pre-production single-asset mining stocks. They're a binary bet on one single project, so any small piece of news, good or bad, causes these massive exaggerated swings.
But what's the trend right now?
Well, it's rebounded strongly off those lows. It's consolidating above that $4 support level. And critically, it's trading above both the 50-day and 200-day moving averages.
Which is a bullish signal.
It confirms a bullish short to intermediate term uptrend, technically speaking.
What about momentum? Does it have room to run?
It seems to. The RSI, the Relative Strength Index, is at 37.41.
So it's not overbought.
Not at all. In fact, it's actually closer to oversold territory. So there is plenty of technical room for an upside move if one of those catalysts hits.
So what are the key levels people should be watching on the chart?
Near-term support is really strong at that psychological $4 mark. On the upside, you've got resistance right around $5.
In the big breakout level.
The aggressive target, if a major catalyst hits, is up at $8.
Which brings us back to what the analysts are saying. Van Eck is buying, but the consensus is still pretty cautious. Mostly holds. Why the disconnect?
It's often about timing. The consensus price target is $5.50, which is still a 23% upside. But a hold rating often means analysts see the value, but they're waiting for those binary risks to be cleared.
They want to see the construction update or the partnership confirmed before they go to a buy?
Exactly. They acknowledge the potential, but they're hesitant. That high target of $8, though, that tells you what they think is possible once those hurdles are cleared.
So let's put it all together. What's the final verdict, the investment thesis here?
Our thesis is bullish. We had scored an 8 out of 10.
And the rationale for that?
It's very specific. It's driven by that dominant U.S. resource base, the technicals that suggest it's undervalued, and this cluster of multiple binary upside catalysts, all expected in the next few months.
So it's an opportunity for both traders and long-term investors.
I think so, yes. It's volatile enough for short-term catalyst-driven trading, but because of that irreplaceable asset, it's also a really powerful long-term holding. It's levered to the whole multi-decade EV transition.
So final advice for anyone watching this stock.
Monitor the operational progress closely, the construction milestones, the costs, the timeline, and keep an eye out for any future capital raises because that will hit volatility.
And to wrap up, it's important to remember the bigger picture here.
It is. If we connect this to the bigger picture, you have to remember that this isn't just a commodity play. This is one of the foundational pieces required to enable North America's entire green energy transition and secure supply chain independence from foreign competitors. That geopolitical importance gives this asset an inherent strategic value that goes far beyond the daily price fluctuations of lithium itself.